One of the most common questions we get here at Stock Trades for somebody who's looking for a more passive style of investing, they don't want to pick individual stocks. They instead want exposure to the whole index or perhaps a particular basket of stocks in terms of an ETF or a mutual fund. They're asking us all the time whether or not they should be choosing index funds, mutual funds, or ETFs. And when somebody asks this question, I can tell right away that they definitely don't understand the true functionality and the true structure of these managed products. So we decided to make a video on it. In this video, we're going to go over the differences between index funds, ETFs, and mutual funds. We're going to explain the benefits and the downfalls of each, and I'm going to give you a little tidbit right after the introduction here that's going to answer the index fund versus ETF question in a couple of sentences. Let's go. So if you're sitting there wondering whether or not you should invest in index funds or ETFs, I'm going to tell you right now, you're essentially deciding whether you should invest in the exact same thing. Because index funds are ETFs and ETFs are index funds. However, it's important to note that not all ETFs are index funds and not all index funds are ETFs. And the easiest way to describe this is to essentially show this Venn diagram here. So what ETFs would be outside of this range? What ETFs would not be qualified as an index fund? And if you look to the more popular ETF lately, the ARK ETFs, which are managed by Catherine Wood, these ETFs would not be considered index funds. And why is that? Well, it's because Catherine essentially picks what stocks are contained inside of these ETFs. They don't track a particular index. Whereas if we look inside of this bubble, the index funds that are ETFs, we could look to an ETF like the iShares S&P TSX 60. They trade under the ticker XIU, which is essentially an ETF that tracks the performance of the S&P TSX 60 index. It's actually one of the oldest ETFs ever. It came into existence in the very early 1990s. So what index funds would be outside of this? What index funds are not ETFs? And that would essentially be index funds that are mutual funds that track an underlying index. So you may be saying, well, Dan, XIU, it tracks the top 60 stocks on the TSX. This can't be an index fund, right? Because it doesn't track the whole index. They pick the stocks. But the fact is, there is an S&P TSX 60 index, and this ETF aims to track that index. So the benchmark of XIU would be the S&P TSX 60 index. To dive a little bit further into this, we need to understand that an index fund is essentially an investment strategy that is taken on by an ETF or by a mutual fund. And a mutual fund or an ETF is a legal structure. Yes, these are both baskets of stocks, commodities, bonds, whatever you wish, but they are very different in the way that they issue shares and in the way the underlying assets are held. But for right now, just understand that, again, indexing is a strategy that these managed products, mutual funds, ETFs, deploy for investors looking to buy them. So if you're truly asking the question of an ETF versus an index fund, only thing that would make logical sense here is if you're comparing an index fund that is an ETF to an index fund that is a mutual fund, which again, I'll go over in this video. But next up, I want to explain exactly how an ETF works and how a mutual fund works so that you can decide what type of index fund would ultimately be better for you. So what is an ETF index fund? Well, an ETF index fund is essentially a basket of stocks that aim to replicate a particular index. Now, a ETF manager can do this a couple of ways. It can do it by fully replicating the index. That essentially means buying every single underlying stock on the index, or it can do it by sampling a particular portion of an index. So if a particular index contains 100 different stocks, a manager could buy those 100 stocks, or they could take a sample size of what they feel would replicate the index better, say 20 stocks out of those 100, and instead just buy those. This can lead to lower turnover and lower fees, but it can also lead to higher tracking error, which is a pretty big thing you need to keep an eye on with index funds. So a lot of people think when they buy an ETF index fund that if the index returns 10%, they'll essentially just return 10%. But that isn't how it works. They have something in an ETF called tracking error, which is something you really need to pick up on and track in your current index funds or prospective index funds. So what exactly is tracking error? Well, an ETF has people behind it. It has people managing the fund. It has people taking care of the logistics of it all. And it also has to buy and sell units and underlying stocks in the fund to balance and create a replica of the index. These cost money, and ultimately that money will come from the overall returns of the ETF. You might see an index like the S&P 500 or the TSX gain 10% in 1 year, and your ETF index fund that tracks this only makes 9.8%. So if you're wondering why, this is exactly why. It is the tracking error of that ETF. So essentially, what does the ETF do once they've figured out the basket of stocks or the sample of stocks that they want to own? Well, they'll go to a brokerage and they'll buy the underlying assets from that brokerage. And in return, they'll give the brokerage the prescribed number of units. And with an ETF, this is essentially like an ETF's IPO. If the ETF has 50,000 units that it would like to begin trading on the market, it would buy the underlying assets from the brokerage. The brokerage would take those 50,000 units and it would sell them for a profit on the market. And this is exactly why an ETF trades much like a stock, whereas, and I'll get to it later in the video, a mutual fund does not at all. There is some huge differences. So when you buy and sell an ETF, you're actually not trading the underlying stocks. You're just trading the unit of that ETF. And as a result, ETF index funds carry with them significantly lower fees because not only are they passively managed, but you're not actually buying the underlying stocks within it. The portfolio is not consistently being rebalanced. Instead, you're just buying a unit which tracks in price relative to the underlying assets. And another huge thing with ETF index funds comes from liquidity. A lot of investors think the liquidity, or essentially how easy it is to trade, actively trade an ETF, comes from the ETF itself, the unit. However, this is not the case. The liquidity, or overall how easy it is to trade an ETF, comes from the underlying assets. If the underlying assets, stocks, commodities, whatever it would be, in the case of an index fund, it would be primarily stocks. If those are liquid, the ETF will be liquid. This is an error that a lot of beginner investors make. So because they're passively managed and because there doesn't need to be much rebalancing or transactions going on in the account, some of these index funds are ridiculously cheap. I mean, if we look to SPY, the index fund that tracks the S&P 500, it has management fees of 0.09%. And if we look back to the ETF index fund I was talking about earlier in the video, the iShares S&P TSX 60 ETF, it has management fees of 0.15%. So these are some ridiculously low fees when compared to, say, a typical non-index mutual fund that could carry, 2.5%. But as we go into more specific index fund ETFs, the fees do get a little bit higher. For example, if we look at XIT, which is the iShares S&P TSX Capped Information Technology Index, it essentially is an index fund that aims to track the Canadian Technology Index, and it has fees of 0.55%. In these more specialized ETFs, you're going to get higher management fees. But in the broad-based ETFs like SPY, like XIU, they're going to be a lot cheaper. And this attracts a ton of investors because they can essentially own the whole market in a single click. and they really don't have to pay that much, $15 on a $10,000 investment every year. This is pretty much a passive investor's dream. So now that we know what an ETF index fund is, we can now focus on what a mutual fund index fund is. And as I stated before, an index fund is an investment strategy. So pretty much an ETF and a mutual fund with an indexing strategy are going to be much the same, but the legal structure of them is where it changes dramatically. So like I said, with an ETF, the ETF purchases the underlying securities and then gives the prescribed number of units to the brokerage in which they sell. With a mutual fund, it's a little bit different. You essentially pool your capital with everybody else, and the fund manager purchases underlying assets, and in return, you get units. So a mutual fund will essentially have a net asset value, which is the total value of the underlying assets divided by the number of units it has. So mutual funds do get a bad rap for having higher fees, but a mutual fund that is an index fund does have dramatically lower fees. You can see some of them that are 0.1%, even 0.05%, much the same as a ETF. But one of the key differences with a mutual fund and an ETF, and it's something that we're going to go over next in the advantages, is the fact that a mutual fund does not trade actively like a stock. If you wanted to sell an ETF, regardless if it was an index fund or not, you could simply go on your brokerage, put an order in, and if it's liquid enough, it would sell right away. With a mutual fund, if you wanted to sell that fund at 10 a.m., you would put a request in, and at the end of the day, the net asset value per share of that mutual fund would be calculated, and that is the price you would get. Your investment would not sell right away. There's also another key difference between an ETF and a mutual fund, and that is distributions. When a mutual fund issues a distribution, it's often simply reinvested into new units. So a quick example on how mutual funds deal with distribution. If you own 10 shares of a $10 mutual fund, and that mutual fund issues a $1 distribution, your mutual fund is going to be worth $9. It's going to have a net asset value afterwards of $9. You may think, whoa, I just lost 10% of my mutual fund's value. But the reality of it is these portfolio managers and these mutual fund managers will take your distributions and invest them back into new units. So even though your mutual fund is now worth less on a net asset value basis, you have more units to equal out that cost. Whereas the distributions on an ETF are just simply paid out to its shareholders. So now that we know what an index fund is and that it can be either a ETF or a mutual fund, we need to decide on which one we want to buy. And in my opinion, the vast majority of investors are going to be much better suited just purchasing an index fund that is an ETF. So why do I believe that? Well, first off, index funds, ETF index funds are significantly cheaper in terms of management fees still than a index mutual fund. If you take two that track the exact same index, there is a very good chance that the ETF is going to be cheaper. Secondly, index funds trade like stocks. I can't see any situation where this would be taken as a negative. With a mutual fund, you would have to wait until the end of day, until the net asset value is calculated, where an index fund, if you wanted to sell it, you could simply sell it in seconds through your brokerage. Index funds, ETF index funds are often commission free. So you can go to a brokerage like Questrade or Interactive Brokers and purchase them without having to pay commission. But the number one advantage of an ETF index fund over a mutual fund index fund is the tax advantages. So if we go back to the structure of an ETF and a mutual fund, like I explained at the beginning of this video, you probably understand now that when you sell an ETF on the open market, none of the underlying assets in that ETF are changing. The ETF itself holds the stocks, and all you're simply doing is trading a unit on the open market. So when you sell it, it doesn't trigger a capital gain inside of the fund. Whereas with a mutual fund, you're essentially pooling your money together and you hold units. So if you ever wanted to sell a mutual fund, what essentially has to happen is the fund manager has to sell underlying assets to get liquid cash to be able to pay you out for your units. What this does is this essentially triggers taxable gains inside of that fund. They're having to sell underlying assets at a loss or at a gain. And in the end, this results in more taxable transactions inside of a mutual fund as compared to an ETF. And ultimately, those taxes are paid by you. So this is why an ETF is much more tax efficient. And these are pretty much 4 primary reasons why I would essentially never choose a mutual fund index fund over an ETF index fund. So everybody, I really hope you enjoyed this video. I hope it helped you understand that there is no true answer when you ask the question, should I be investing in ETFs or index funds? Because they are essentially one and the same. Again, not all ETFs are index funds, and not all index funds are ETFs. Some of them are mutual funds. And in terms of ETFs, some of them are like the ARK ETFs, actively managed. They have higher fees. They don't rely on a specific index, so they need managers to be able to balance the portfolio, to be able to choose stocks. That is why you'll see some ETFs have significantly higher management fees. These are typically not index funds. They are pools of specific stock selections by the managers. Again, there isn't too many situations where I would ever prefer a mutual fund index fund over an ETF index fund. And overall, if you're looking for a passive approach to investing, these are a great way to do so. Just understand that if you're purchasing an index fund, you are at the mercy of the market. This can be on the upside and this can be on the downside. When the markets go up, you will never earn more than the market. In fact, you will earn less. And when the markets go down, you will face the full brunt of the market. For example, the TSX fell 35% back in March of 2020. Your portfolio, if invested solely in that index fund, would take that 35% hit. Whereas if you were picking individual stocks, there is a chance that your stocks could weather the storm a little bit better than the overall index. And this would be primarily evident in the TSX crash back in March because the TSX is so focused on oil and gas. If your portfolio didn't hold any oil and gas, it's very likely that you outperform the index during that crash. But they are great investment options. I use index funds when investing in US stocks, and I instead focus my individual picks on Canadian stocks because I feel I have much more expertise in that area of the market, and it allows me to deliver strong stock picks to Stock Trades Premium members. So I invest in passive index funds in the United States in my RSPs that allow me to essentially set and forget this portion of my investments. So drop a comment down below. Let me know what index funds you're looking at today. And are you an indexer or are you a individual stock picker? Also, if you were confused on this subject, let me know if I solved the question for you of index funds versus ETFs. And also let me know if me explaining the structure of these products also helped you identify the key differences and obvious similarities between all these products. Again, like the video, subscribe to the channel, and stay tuned for more great Canadian content. We'll see you next time.